General Shorting Info Part 2. Technical trading should primarily focus on the technicals of the chart, as well as how it relates to the sector performance it's in and what the general market mood is. This is especially true now with quant firms and algos in control. Covering Part 1 about doing basic forensic accounting, understanding the balance sheet, net income, capital expenditures, and the need for fundraising, as well as checking into the social presence, Twitter mentions, news pumps, looking into their own owners, SEC filings. This is all part of it. You cannot ignore the importance of knowing what you are shorting, just as if you were investing in it. Institutional algos consider all this as part of their complete formula, and so should you. Relate that to this video's example trade of HOFV. A quick glance into their financials. Net income does not look healthy. Granted, a few quarters could be explained by the capital expenditures, and we can see that on the cash flow. Their balance does not look healthy either, and in the latest news, CEO actually pointed out the need of a 300 million figure to achieve their vision. While they may have raised 100 million, we know 30 came from the share issuance sub $250, giving us an idea of where the company values themselves. Looking closer at their 10K filings, we see that they have a sizable compensation expense as well as a sizable liability payment. And that would eat into the rest of the quarterly reported cash amount. This information together, I would expect the company to be overvalued in the $6 to $8 range. And that's all that matters to me as a person trying to capture that outsized move. Once we understand what we are dealing with, we have better odds at making the trade in the ultimate direction we think it's going to go. So let's drive this point. Trade like an institution. You should only buy or cover in strong demand zones where you think there's value in the stock fundamentally and technically, and you should only sell or short in strong supply zones, i.e. vice versa to the fundamentals and technicals. As we have multiple time frames, that is the reason why in tandem your entries must be incremental on both sides of the equation, as there are multiple SD zones of varying strength. If a volume lingers in a specific area on a 5-minute chart, but it also corresponds to the same area multiple times on a daily chart, that indicates more overall volume churn and thus a stronger demand or supply zone, depending what direction the price action is coming from. It's your job to determine what time frame you are most comfortable with. I look at the top-down approach. My niche starts from hourly charts and down. As per Part 1, I will know everything about the company. I will know where the volume has been trading over the last few years per volume profiles, as well as over the last few days and even hours. I would gauge the excitement and the sentiment of the stock as it relates to the sector and the market. Look to see where the company issued raises to understand how they value themselves. All this to understand my possible exits, and then use the technicals for proper entries. Taking HOFV as the video's example, I specifically posted my entries over 5, 5.4, and 5.8, as well as 605. We're playing probabilities here, so I could not possibly know how high it goes. But as we are on the backside, after an initial NFT hype for weeks and after a Benzinga interview pump, we have our levels of risk combined with a fundamental understanding of the stock. We're not blindly shorting this at 8 at the top, even though fundamentally it's not worth 8 at this point. But that's where the technical and fundamental understanding comes in. All-time high, big breakout moves provide us with no risk profile to analyze. However, after the interview, we now know they need a couple $100 million more. Their net income is negative, so most likely they will have to raise more funds. So we have a fundamental and a technical risk protection. A short consolidation and a move up or down indicate supply or demand zones. They are stronger the quicker the move is. Viewing from a top-down approach, the 4-hour chart is showing us multiple large wicks over 7.5 and 7, followed immediately by a large red candle. This indicates a lot of selling within one day. It went from over $8 to almost $5. It is a clear strong area of supply. Equally, we can notice an area of demand where the price consolidated and broke out 350s. This, combined with the volume profile, gives us an understanding where we want to trade, but it also doesn't necessarily provide us with an accurate entry option as the ranges are too great. So for that reason, I zoom in on the hourly. We can see the sells are much greater in volume than the buys that drove the price up. We now and only now have a supply zone and a defined risk. Now that we have a high that rejected, now and only now we have a trade that allows us to define our risk. Let's get back to this concept of trading like an institution and only taking supply and demand zone trades. If you missed an entry, you don't chase. We do our top-down technical analysis, we know the large SD zones, we look at the hourly, and we get a more granular understanding that there is another SD zone around 4.5. We can see that the majority of price on the hourly traded in this area. After arriving from below, it expanded to the upside, only to come down the next day and hold the same area. We are currently at this SD zone. We cannot trade that area unless with a small start in the ultimate direction determined by our volume analysis that we discussed in part 1 of the video, and understanding what the company is, what their news is, their filings, and what their accounting is telling us. At the same time, we know there is a strong supply zone above 6 and so forth. It has been 4 days of this run. We now have a lot of information. I've covered an entirely different stock in the previous video, but their chart patterns are almost identical. We have our large SD zones on bigger time frames, and then we found our granular SD zones on the hourly, and we take positions only around those. In this example, let's look at the 5 minutes. We want to buy or cover in 4.2, and we want to short anything over 5.1, 575, and surely over 6, more so as an emotional number. If it does not happen, we are tracking multiple stocks, and we don't just take random entries, but we wait for the perfect ones. I personally place my entries 3 hours in advance. Day trading isn't necessarily capturing the move as it happens within the seconds, but once you understand how this game is played and trade the SD zones, and you set your entries within acceptable risk and reward parameters for you, you don't even need to be there for them to execute, or to not. And you either have a good R&R, or you do not have a bad trade. Once again, be an institutional buyer and be cautious with your entries, only taking the best. Supply and demand zones is what you should focus on primarily. Chart patterns, indicators, trend lines, that's all just makeup. You have to understand the quote-unquote person behind the makeup. Volume and price and their interaction tell the story. Everything else is there to just confirm your own biases that will work when it works and fail when it doesn't. People will say, oh, what a fake out, that should have broken out, or trend line is broken to the upside, time to add, ignoring the fact that it most likely worked because it was within the demand or supply zone. As an example, HOFV, we have a clear downward trend line with perfectly matching high wicks, and is broken at around 473 to the upside. Many traders will go long there as the trend line breakup matched the previous biases, ignoring the fact that it was indeed the demand zone near 4.2, 4.3, an area that has held previously and broke out with significant volume, confirming buyer interest. I started covering incrementally 475, 465, and covered the majority at 430. Algos are on this, and people who trade big money are also going to consider this a double bottom, and that just happens to be another word for demand zone, and that is what causes these reversals. Then we have to expect an even bigger move because of the trend line break chasers, MACD flip over chasers, RSI oversold chasers. They are all actually buying late, determining their entries based on confirmation biases of various other indicators that are all secondary by importance to volume and price. At the price of 4.3 covers, I announced my short ad in the room, quote, go into 6, end of quote, and had placed my entries at 5, and sized up 5.4, 5.8, and over 6. If it didn't hit those, I would have had whatever size I picked up at whatever node and be happy with it. If I had more at 6.4 and even more at 7. Alternatively, I could sit here and wait all day to see where the move stops. Maybe I would get a slightly better entry, or maybe I would miss that peak over 6 and then never chase down. So really, what's the difference? As long as you're sizing in properly in S&D zones, after we've done our homework on the backside of a move, going forward, our next ads are over 575 and covers below 475. We don't panic in between, but obviously profit taking is allowed to reduce your position and improve your averages. The reason why I never chase and add size inappropriately is also so that I can stay emotionless. If it goes over 6 and 6.5, I welcome the move, for I will add more and improve my average to near that price. My expectation was that this would go over 6, but there were smaller supply zones around 5.5 that could have been rejected. So I personally like to size in small, going up in price, up to my final expected highest entry. Incremental entries and exits to me go hand in hand with understanding varying strengths of S&D zones, depending on what time you are trading in, or using to determine them. By properly preparing my sizing and placing the entries in such a way that the entire move is calculated, I avoid a potential of a squeeze or emotional mistake, because I literally do not have the buying power to make bad entries. In this example, my incremental adds were 1/10 at 5, 1/10 5.4, 1/10 5.8, 2/10 605, 2/10 over 6.5, and 3/10 725 for a full position with an average expected of around 6.5. I do it this way because there's no way to know what will reject, but I increase the size for S&D zones that are visible on bigger time views. It's quite possible that the 5.4 and 5.8 may be the last and only ads I get. If that's the case, I would stick with my 1/5 size, exit incrementally in the next demand zone, and only add on pops in supply, with constant further risk control and expectation that this could go higher, just as it could go lower, thus always trading around a core position. Conversely, as the price hovers in a certain range for another day, the strength of that area increases as it collects more volume horizontally. So next time it pops over 5.8, I could add 2/10 of the position and 4/10 over 6.5, but I would also expect 5 to hold, and my exit could be final at this area. This is how you manage your risk, by only taking the best entries and trading within S&D zones and sizing in properly within the zones that are visible on bigger timelines. Supply and resistance lines work together with supply and demand zones. You will notice on my charts I have those drawn as well. Varying thickness relates to the expected strength. We have supply and demand zones where volume lingers, where we know buyers and sellers really are, and SR lines is the same concept. We don't just take one candle of a small time frame for supply and demand zones, and neither is the case for the support and resistance lines. True SR lines only materialize when there is volume. As an example, let's get back to HOFV. We only want to consider high volume nodes, candles of the bodies, and wicks in both directions. These are the turning points as long as the volume is abnormally high. Looking at HOFV, I go back to at least a year or more just to see the entire picture and the history of the chart. Start from the highest volume first. We have a candle November 5th. That tells us a story. It already, in combination with what we know about the company, their finances, their PR work, is painting a good picture for me as to what I should expect from future moves. We mark the high of the candle, as well as the lower and the upper portions of the body. I'm not marking the bottom of the wick in this case because my expectation that it is entirely short covering. Next up we have November 13th and November 16th with a massive drop. Following the volume, we come to the recent past. And we mark out all the top wicks and the top and bottom of the bodies. As the volume was too low in the 26th compared to the rest, and even the 23rd is a bit questionable, I may not be interested in marking those. So we don't want the low volume bars, we just want the highest ones with double the volume preferably. Also, I don't like to mark the bars that don't create the change. So this inside bar is less of an interest for me, as nothing actually changed. This one is just too low volume. This one is also too low volume compared to the average. If I had the average volume on, it would be clearing those bars above. Alright, so now let's go to the 5 minutes, and we should notice something interesting. To no surprise, our S&D zones and our SR lines should match up. Look at this chart and tell me you don't see clearly the reason why I said short over 5.4, 5.8, and 605 as my expected adds. Your support and resistance lines will match supply and demand zones, and they will congregate in those areas, as that is where the volume cost price changes. As per part 1 of my video, if the price moves up to 5.3 area and then rejects, we are confirming once again that as a resistance, matching a daily SR line as well as our own identified recent supply and demand zone. After a VWAP retest, we broke through that and rejected on our next SR line and SD zone twice, around 5.7, 5.6, indicating that as a stronger supply zone and a daily resistance. It's good calculatable risk to then be shorting these rejections incrementally, knowing that we have more S&D zones and resistance lines above us, and covering sub 5.3, sub 4.7 in our demand zones, and on the tests of previous resistance lines, turn support. This is what you want to use to trade. I hope this video helps. Part 3, I will finally cover another complicated subject: how to spot a short exhaustion and when the front side of the move is truly over, as well as how to understand how forced covers and margin calls play a role in creating your best possible entry and why patience is your best friend.